All right, we're looking at the Sandoval Family case study on private markets. Let's read that first question, then we'll jump into the paragraphs. Which of the following investment methods are Alejandro and Maria Sandoval most likely using for their investment in TechWave? So we've got direct investment, co-investment, or fund investment. So as a reminder on these three, direct investment is going to be the Sandovals investing directly into TechWave. So they're basically giving money directly to TechWave, and being a direct investment, they're typically going to be the only investor in that deal. For a co-investment, and maybe they're not the only investor, but that should be kind of like sourced by them. They're not really investing alongside anybody. So then that's going to be the main difference between that and a co-investment. A co-investment will be them investing directly in the company, but they're going to be investing alongside other private equity investors, and maybe the other investors kind of source the deal and are just like looking for more capital from the Sandovals. And then a fund investment will be the Sandovals investing in a fund that is then investing in TechWave. So let's read and figure out which of these they kind of fall under. The Sandoval family, led by Alejandro and his wife Maria, is known for their substantial wealth accumulated through a combination of a successful technology firm and a diversified real estate portfolio. Alejandro founded a cybersecurity company, SecureNet, which he recently sold for $45 million. Following the sale, Alejandro and Maria have focused on growing their wealth through private market investments, including private equity, private debt, and real estate. To manage their investments, the Sandovals have engaged with Sterling Advisors, a financial firm that specializes in high net worth clients. Sterling Advisors recommended a mix of private equity and private debt instruments to enhance portfolio diversification and potential returns. Alejandro and Maria are particularly interested in buyout equity and mezzanine debt structures. So we haven't gotten to TechWave quite yet, but one thing I would just point out to this point is they recently sold the company for $45 million. They're probably not making direct investments at that level of wealth. Direct investments are typically going to be made by like endowments, foundations, people with billion plus in assets. So just one thing to keep in mind there. And that's mainly just because if you're making direct investments, you're going to need to have significant resources on the investment side to kind of like source and analyze those types of deals. And they're also working, that already says they're working with a financial firm. Anyway, Sterling Advisors identified an opportunity to invest in a private equity buyout of TechWave, a mid-sized software company facing operational challenges but with significant growth potential. The proposed buyout involves a leveraged buyout structure where the purchase will be financed with 70% debt and 30% equity. Sterling Advisors suggested that the Sandovals participate directly in this investment opportunity, allowing them to benefit from the firm's extensive experience in managing complex private equity transactions and providing access to resources typically reserved for institutional investors. Okay, so I think we've got enough information here. So we're participating directly. However, the deal is being brought to them. It's a proposed buyout that's kind of already structured, and then they're just asking the Sandovals if they want to participate. So that's going to fall not under direct investment, not under a fund. They're not investing in a fund. They are co-investing. That is all going to go back to what we talked about at the beginning of the question in those three options. Answer B. Question 2. Given the Sandoval's investment strategy in TechWave, which phase of the private asset investment lifecycle is most critical at this stage? So we read down to here and we heard about the TechWave investment. Let's read a little more and see if we get any new information. Additionally, the Sandovals are considering an investment in mezzanine debt fund. Okay, so it looks like we're just strictly looking at kind of this paragraph and before related to the TechWave. So what life cycle is most critical at the stage? So we've got A, capital commitment, B, capital deployment, or C, the exit. So capital commitment, this would be what we're looking at for TechWave. I guess this would be kind of their capital raise phase. So deciding where they're going to, I guess for the Sandovals, it'd be deciding where they're going to be investing their capital. But in this instance, we're already kind of deciding we're making the investment in TechWave. So I think we can rule out A. For B, capital deployment. So TechWave, again, they've kind of already gotten the funds, and so they have the capital. Now they need to decide what to do with that capital, which is what the capital deployment phase is. They need to figure out how to properly kind of deploy that into the business, whether that's investing in distribution or build out of the products or whatever else. That's going to all fall under that capital deployment phase. So B is probably going to be our answer. Let's look at C, exit. Exit is going to occur much later on when they're trying to sell the company. They probably wouldn't be raising capital right now if they were planning on exiting in the near future or in the exit phase. So we'll rule out C and stick with B, capital deployment. Question 3. What is the most significant financial risk associated with the Sandoval's investment in TechWave? So I don't think we need to read any more since we've already read through the TechWave. So let's look at these answers and see if we can figure that out. So we've got A, high liquidity risk. There definitely will be liquidity risk. This is a private equity investment, and so there's going to be limited liquidity for the Sandovals. So that could be our answer. Let's look at these other two, though, since it does say most significant. B, elevated debt levels. So this is also going to be a financial risk, considering it's a leveraged buyout. They're using 70% debt to fund this, and the other key here is they're facing operational challenges. So they're facing operational challenges. It's going to be hugely levered even more with this leveraged buyout. So this is definitely going to be a significant risk. C, increased interest rate exposure. There's no mention of increasing interest rates. I mean, they're going to have more debt, but I don't think that doesn't really talk about what the debt makeup is. So I think we can rule that out. So we're looking at A and B. These are both risks. However, we do need to consider what is the most significant risk. I think from a liquidity standpoint, the Sandovals have significant wealth. They know that they want to grow their wealth more through private market investments. They're pretty aware of or able to take on that risk of a long time horizon, low liquidity. So I would lean towards going with the elevated debt levels. This seems like a more specific financial risk for the TechWave investment, given that they have operational challenges and we're increasing the debt load through LBO. So we'll go with B. Question number 4. While Maria explores opportunities to develop commercial properties in emerging markets, which of the following is a primary risk she should most likely consider? All right, so I think we read to here, so we need to read until we talk about real estate investments. Additionally, the Sandovals are considering investment in a mezzanine debt fund, which provides capital to mid-market companies looking to expand but unable to access traditional financing. The mezzanine debt fund offers a higher yield than senior secured debt, though it comes with higher risk due to its subordinate position in the capital structure. Maria, who manages the family's real estate portfolio, is also exploring opportunities in private real estate, particularly in developing commercial properties in emerging markets. She is intrigued by the potential high returns, but is cautious about the risks associated with less mature markets. All right, so it looks like that's what this is related to. We're interested in the risks associated with those emerging markets. So let's look at these different types of risks. Which of the following is a primary risk she should most likely consider? A, regulatory risk. Yes, this is certainly going to be a risk. Rules could be far different in emerging markets than in developed countries. I don't think it says where the Sandovals are from, but there's definitely going to be regulatory risk from the standpoint of rules being different, but also emerging markets typically have more corrupt government officials, which could also lead to more issues related to commercial property or real estate. So regulatory risks should certainly be on the radar. I'm going to circle that for now. B, market liquidity risk. From a liquidity standpoint, I mean, commercial real estate in a country like the US is already pretty low liquidity. I don't know that it being in an emerging market necessarily means the liquidity is going to be worse. or there's going to be more liquidity risks. So I don't know that that's a huge consideration. And like we kind of mentioned with the last question, I mean, they have significant wealth and they're aware of the liquidity from investing in private assets. And then C, low expected returns. I mean, I think it mentions here that we're expecting potentially higher returns, and due to the uncertainty, we should only be doing this if we're expecting higher returns. So we'll stick with A. The regulatory risk is the biggest risk of these three.